There's a very important aspect to the buying and selling of businesses that is often overlooked and yet always argued about in courts and during negotiations. And this is the concept of working capital. So what is working capital? What does that mean? So typically when you buy a home and you value the home at a particular value, let's say it's $1 million, and you expect that when you buy that home, it comes with certain features, like a roof or a working HVAC unit and running water. And if it doesn't have those features and you've spent the money, then you expect that there would be an adjustment. So you would negotiate that really the house is worth less because you're expecting to buy a house with a roof. If you have to spend $100,000 on a roof, then you didn't buy the house for $1 million, you really spent $1,100,000 for the roof. So you try to get that set off of the purchase price. So that's pretty standard in the market. And that's why you do housing inspections before you close on a house. However, in the case of a business, there are certain things that you can't see but are crucial within the business that you expect would have certain things. For example, when you buy a business, an operating business, you expect that there is a certain amount of money, accounts receivables, bills going out, inventory that you can sell right away, that make sure that the money is always coming in the ordinary course. And that money is used to pay for its ordinary liabilities, rent, payroll, suppliers. That money going in and going out is typically called working capital. Now, accountants can help you determine, based on the financial information of a business, what that working capital really is. And a lot of the time, the owners of the business know what it is in their head. They know it intuitively, but maybe they've never really set it out on paper. But it's important that when you're negotiating the buy and sell of a business, that a certain level of working capital is kept in. Otherwise, on the buyer side, if, let's say, they buy a business and there is no or insufficient working capital left in the business, they'll have to go out of pocket and put more money into business to help pay for rent and staff, much like a person that has to go out of pocket to repair the roof when they expected that the house that they bought had a roof. Similarly, here, you want to make sure as the buyer of a business that there's a sufficient level of working capital so you don't have to go out of pocket even more and spend more on this business while you're stuck with the liabilities. Similarly, someone who's selling a business, on the other hand, needs to make sure that when you're looking at the purchase and sale agreement and you're looking at what working capital needs to be left into the business, that you negotiate these terms. Otherwise, the purchase price is typically set off of whatever working capital you did not leave in. That's the important reason as to why you should pay attention and ask advisors as to what working capital means, what are your obligations before you sell the business. Otherwise, you will end up getting less than what you expected on the closing of the sale of your business. It's a little bit complicated, but make sure you ask your advisors, both an accountant and a lawyer or any other business advisor, for help when you're buying or selling a business. Thanks for watching, and if you like these videos, click like and subscribe.